There is a statistic that keeps me up at night. It is a number buried deep in a report by MetLife Investment Management, and it predicts the future of the American middle class more accurately than any politician ever could. The report estimates that by the year 2030, institutional investors, meaning hedge funds, private equity firms, and insurance companies will own 40% of all single-family rental homes in the United States. Think about that for a second. 40%. We are not talking about apartment complexes or high-rise towers. We are talking about the 3-bedroom house with a yard, the starter home, the retirement cottage, the specific asset class that has served as the primary vehicle for wealth creation for regular families for the last 70 years. Nearly half of that market is being absorbed by algorithms and asset managers. They are not buying these houses to live in them. They are buying them to hold them forever. They are buying them to corner the market on human shelter. The media tells you this is happening because there is a housing shortage. They say, we just need to build more supply. But as a forensic historian, I can tell you that is a comfortable lie. The supply is being built, but it is not for sale. We are witnessing a structural shift in the global economy. We are moving from an ownership society to a rentership society, and this transition is not accidental. It is a mathematical necessity for the financial elite. To understand why you can't afford a home in 2025, you have to stop thinking like a home buyer and start thinking like a bond trader. For the last 40 years, the foundation of the financial system was the government bond. It was the safe asset. You bought it, it paid you interest, and your capital was secure. But in a world of $36 trillion of debt and persistent inflation, bonds are no longer safe. If inflation is 4% and the bond pays you 4%, you are making zero. You are running on a treadmill. So, the smartest money in the world needed a replacement for the bond. They needed an asset that was safe, but also inflation-proof. They found it in your neighborhood. They realized that a single-family home is the perfect bond. It has a tangible value that rises with inflation. And instead of an interest payment from the government, it pays a monthly dividend called rent. And who pays that rent? You do. They have turned the American family into a yield farming operation. But this system only works if you, the individual, cannot compete with them. It only works if you remain a renter. And this is where the investigation gets dark. Most people assume this trend is just the free market at work. But if you look at the ledger, you find a specific starting point. You find a patient zero. The modern corporate takeover of housing did not begin in a boardroom. It began in a government office in 2012. Following the 2008 financial crash, there were hundreds of thousands of foreclosed homes sitting on the books of Fannie Mae and Freddie Mac. The government had a choice. They could have created a program to sell these homes back to individuals. They could have helped regular people get back on the property ladder, but they didn't do that. Instead, the Federal Housing Finance Agency launched a pilot program called REO to Rental. This program was designed to sell these foreclosed homes in bulk, thousands at a time, to large institutional investors. They effectively said, we prefer Wall Street landlords over Main Street homeowners. They transferred billions of dollars of real estate wealth from the public to the private equity sector for pennies on the dollar. That was the seed. Now, in 2025, we are seeing the full harvest. This is not the first time a ruling class has systematically stripped the ability to own property from the working class. To see where this leads, we have to open the case file on one of the most ruthless economic transformations in history. We have to go back to 18th century England, to an event known as the Enclosure Acts. Before the Industrial Revolution, England looked very different. A huge portion of the countryside was known as common land. This land did not belong to a single landlord. If you were a peasant, you had rights. You could graze your cow on the commons. You could chop wood for your fire. You could grow a patch of vegetables. This system didn't make you rich, but it made you independent. You didn't need a boss to survive. You had a baseline of subsistence. But then, the economy changed. The price of wool skyrocketed. The wealthy aristocracy, the lords and the barons, looked at that common land and they didn't see a community resource. They saw a balance sheet inefficiency. They realized that if they could kick the peasants off the land and turn it into giant sheep pastures, they could make a fortune. But they couldn't just steal the land with an army, so they did something much more effective. They used the law. Between 1750 and 1850, the British Parliament passed over 5,000 individual enclosure acts. These laws legally allowed the wealthy to put fences around the common land. They enclosed it. They demanded the peasants prove ownership with written deeds. But the peasants didn't have deeds. They had tradition. And in a court owned by the rich, tradition meant nothing. The courts ruled in favor of the landlords. The fences went up. The cottages were demolished. And the self-sufficient peasant class was destroyed. So what happened to them? They had no choice. They were forced to migrate into the cities. They walked into the factories of Manchester and London. They went from being independent farmers to being dependent wage laborers. And here's the kicker. Because they no longer had a home, they had to pay rent to the very same class of people who had just stolen their land. The enclosure acts were the mechanism that created the modern working class. It was a transition from a society of small owners to a society of mass renters. Now, fast forward to 2025. We are living through the second enclosure. The mechanism is different, but the outcome is identical. Today, there are no physical fences going up around your neighborhood. The fence today is invisible. It is built out of two specific materials: cost of capital and technology. Let's look at the first material, the cost of capital. For the average person to buy a home, they need a mortgage. That means they are at the mercy of the Federal Reserve. When interest rates spiked to 7%, the monthly payment for the average house doubled. The mortgage rate is the fence that keeps the regular family out. But the institutional buyer, the hedge fund, the REIT, does not care about consumer mortgage rates. Why? Because they don't use mortgages. They have access to the corporate bond market. They can borrow billions of dollars at institutional rates or simply use accumulated cash. So when you walk into a bidding war for a house, it is an unfair fight. You are bringing a pre-approval letter from a bank that charges you 7%. They are bringing an all-cash offer backed by a $300 billion balance sheet. You cannot compete. The fence is too high for you, but it is an open gate for them. This creates a feedback loop. As they buy more homes, inventory shrinks. As inventory shrinks, prices go up. As prices go up, more people are forced to rent. As more people rent, the rental yield improves, so the hedge funds buy even more homes. It is a machine designed to consolidate ownership. But the second enclosure has a weapon that the British aristocracy didn't have: algorithms. In the old days, a landlord would set the rent based on what the local people could afford. Today, that human connection has been severed by software. Companies like RealPage have developed algorithms that allow corporate landlords to coordinate pricing. The software analyzes the entire market and tells the landlord exactly how much they can raise the rent to maximize revenue. It creates a cartel effect. The algorithm essentially says, if we all raise rents by 20%, the tenants have nowhere else to go. They have to pay it. This is the technological fence. It ensures that the rent you pay is always pushed to the absolute maximum limit of your pain tolerance. We are seeing the rise of entire communities built specifically for this purpose. They are called build-to-rent subdivisions. Drive through the suburbs of Phoenix or Atlanta. You will see brand new neighborhoods with beautiful homes and manicured lawns. But if you walk into the sales office and ask to buy one, they will laugh at you. None of them are for sale. The entire neighborhood is owned by a single corporation. It is a modern feudal manor. The corporation is the lord, and the tenants are the serfs. The serfs have a subscription to shelter. They pay a monthly fee. They maintain the property. But they build zero equity. Every month, the wealth transfers from the labor of the tenant to the ledger of the landlord. The corporate landlords argue that they are providing a service. They say they are professionalizing the housing market. But this language, the language of subscription, masks the reality. What they are really doing is extinguishing the primary ladder of social mobility. For the last century, the American dream was based on a simple mathematical premise. You take a fixed rate debt, a mortgage, and you use it to buy an inflating asset, a house. Over 30 years, inflation eats away at the value of the debt, while the value of the house rises. It was a wealth transfer from the bank to the homeowner. It was the only way a regular worker could legally short the dollar and go long on hard assets. The new enclosure acts are designed to stop that transfer. By turning you into a renter, they flip the equation. Now, you are not the beneficiary of inflation. You are the victim of it. When the currency debases, your rent goes up. You are paying the inflation tax directly to the asset owner. This is the definition of neo-feudalism, a society divided strictly into two castes: the rentiers, who own the assets and collect the yield, and the renters, who own nothing and pay the yield. The World Economic Forum famously posted a prediction: you will own nothing and you will be happy. Everyone focus on the first part. But the forensic question is, if you own nothing, who owns everything? The answer is the entities that are currently buying 40% of the market. They are the ones who will own everything. So how do we pivot? How do we apply this dark history to our own survival strategy in 2025? If the system is designed to enclose you, the only winning move is to refuse to be enclosed. The first step is a psychological shift. You have to abandon the consumer mindset and adopt the owner mindset. In a high inflation, high debt world, cash is trash, but cash flow is king, and control of the underlying asset is the crown. The lesson from the British Enclosure Acts is harsh but clear. The people who survived were the freeholders, the ones who had clear title to their land. The ones who got wiped out were the copyholders, the ones who had vague rights or who rented. In the modern context, the most dangerous position you can be in is zero asset ownership. If you are currently renting, your number one strategic priority must be to get off zero. This might mean changing your expectations. You might not be able to buy the dream house in the city center where the hedge funds are bidding. You might have to look where they are not looking. The hedge funds run algorithms. They look for specific criteria: population density, job growth, yield metrics. They are buying in the major metro areas. They are not looking at rural land. They are not looking at smaller towns. They are not looking at fixer-uppers that don't fit their standardized rental model. They are not looking at raw land that requires work to become productive. This is your gap in the fence. History shows that in every period of currency debasement, wealth flees to the edges. During the Great Depression and during the stagflation of the 1,970 seconds, the people who did best were those who owned productive land, even if it was small, even if it was remote. Land that you can stand on, land that you can improve, land that has no counterparty risk. Productive land is the key. In 1750, that meant grazing a sheep. In 2025, it means land where you can put solar panels to offset energy costs. It means land where you can build an accessory dwelling unit to generate rental income. It means land where you can run a business. You have to think of your home not just as a place to sleep, but as a sovereign balance sheet. And this brings me to a critical distinction. Many financial advisors will tell you that to profit from this trend, you should just buy the stock of the companies doing the buying. They say, buy the REITs, join the enclosers. But forensic history warns against this. When you buy a share of a REIT, you are still inside the financial system. You possess a paper claim on a digital ledger. If the system cracks, if the laws change, you are just another unsecured creditor. The point of the Enclosure Acts was to separate people from the physical reality of the earth, to make them dependent on a system they could not control. Real wealth preservation is about allodial control. It is about holding the deed. There is a concept in law called allodial title. It means absolute ownership of land with no superior landlord. While true allodial title is rare today, the principle remains the North Star of wealth preservation. You want to be as close to the physical asset as possible. The new enclosure is not coming. It is already here. The fences are being built. The gatekeepers are the central banks and the asset managers. They are betting that you will accept the subscription model of life. They are betting that you will be content to pay them rent forever in exchange for the convenience of not having to fix your own roof. But the price of that convenience is your liberty. The peasant in 1750 didn't realize he was losing his future until the fence was already built. We have the benefit of hindsight. We can see the fence being constructed in real time. The data is public. The 40% target is not a secret. It is a business plan. The government programs like REO to rental are a matter of record. The only question left for you is simple. 10 years from now, when the transition is complete, do you want to be on the outside of the fence or the inside? Do you want to be the one signing the lease or do you want to be the one holding the deed? The choice is yours, but the window to make it is closing.